I've got with me in studio Trevor and Peter. Gentlemen.
Hi there, my name's Trevor Hartley. I am a previous business owner and entrepreneur. I also come from a chartered accountancy background, so I understand a bit about finance, and I'm currently heading up the product development team at the London School of Business and Finance. Thank you.
And I'm Peter Stewart. For 20 years, I've been a lecturer and researcher into financial management. I was a consultant to ACCA in development of their syllabus, particularly in the financial management field, and I'm now at London School of Business and Finance as Director of Corporate Training.
I'm Augustine, I'm an accountant and I'm a consultant with the Private Wealth Fund. The case we're looking at today is the rise and fall of Osborne Computers as it applies to working capital management and how it can cause a company to fail. So now we're looking at working capital. Peter, could you please give us an overview of working capital and how this case study itself applies?
Sure, yeah. Now, the story of Osborne Computers is largely a story about a very large business mistake that was made by its chief executive, Adam Osborne, who overpromised on delivery of a product, and that led ultimately to the fall of the company. Now, we don't want to focus on that particular side of things. What we're focusing on behind that is the position that they had at the time of that mistake in working capital. And it should have us thinking about the importance of working capital management because of the unpredictability of businesses, the marketplace, and so on, that we could find ourselves in a position where working capital is one of the factors that leads us to corporate difficulty.
Having said that, and bringing us back to specifics, but we have to actually consider the contemporary issues around Osborne Computers in a way of get them out of the way so that we can concentrate on the working capital itself. In terms of competitors, do you think that Osborne Computers was doomed to fail no matter what happened?
At the point in which Adam Osborne told the market that they would be buying something that was obsolete, and if you bear in mind this was in 1980, then I think it was going to be a very, very difficult problem to overcome. If that were to come out now, it's accepted in the world of buying personal computers that as soon as you've bought your laptop, your telephone, any form of equipment, that it will be obsolete within 6 weeks to 3 months. So it wouldn't be a problem now, but back then I think it was going to be very, very difficult. Not impossible to overcome, but a very, very difficult position.
Thank you. What about, Trevor, what do you think? If they had managed to source their working capital properly and held on for a bit longer, will they have survived?
I think, Augustine, the question you need to be asking yourself is to look at competitors in today's market, which were around then. I think IBM was obviously one of the big multinational organizations, and they were making very good progress in terms of the personal computer industry. Another company which was around then, which was still a smaller company, was the Apple company. And if you look at Apple in terms of how they've grown and how successful they are today, also a company that was focused on innovation, a company that was focused on developing new ways of doing things, I do think that had Osborne Computers been able to hang on and been able to ride this wave, they could have been in a very similar situation to a company such as Apple. However, having said that, we really are going into a bit of guesswork over here, looking at what could be. But I think had they been able to ride this wave, there could have been light at the end of the tunnel.
Let's look at the alternatives we have. Trevor?
I think when we look at the alternatives in this scenario, we're specifically focusing on the working capital. The first alternative that we've laid out is for management to actually have immediately stopped production. The production lines were still continuing, and had management made a decision to immediately stop the production and sell off existing computers, there may have been the cash benefit to the working capital. The second scenario that we're looking at is actually to reduce the cost of the existing production. This would actually have looked at, in a sense, re-engineering the product for cost savings, and again would have been an alternative. The third alternative that we considered is looking at the financing of the working capital. They were going into a time of new research and development, launching Osborne 2, and the solution or possible solution could have been to look at refinancing based on the cash flows going forward in terms of the actual research and development as well as future sales. So those are the three alternatives we're considering today.
They sound like very lovely and broad alternatives. Which one do you champion?
I think what I'm going to be looking at is the alternative of stopping the assembly lines and the manufacturing immediately. When we look at this alternative, something which is prevalent is Osborne were probably victims of their own success. They hadn't been expected to sell a whole lot of computers. They'd got to the point where they were selling 10,000 computers a month. And in order to meet this demand, they went into a frenzy of actually stocking up on inventory. So they had warehouses with thousands of Osborne 1s in, but at this stage the market had started to change. Competitors had started to come in with additional computers, and when the management slip-up came, the assembly lines continued producing, the warehouses continued stockpiling, and if a management decision had been taken very quickly to stop the assembly lines, stop production of the machines, there may have been a situation where they were actually able to reduce the cash outflow, which could have been used to actually address their operating issues, their working capital issues, and having done that, they may have been able to ride this wave. So looking at the first alternative, we're really looking at a situation of a quick management decision, stop existing products, look to sell the products that they already have, but in so doing, save the cash, which could be then plowed back into operations.
So if I may, what you're saying is bring down the level of inventory, increase cash, not necessarily receivables, maybe draw their payables slightly, and in that way shorten the cash operating cycle.
Exactly.
Okay. Peter, what do you have for us?
Yeah, well, option B is the idea of taking Osborne 1, the existing product, and looking to see if in any way that could be made more cheaply per unit. And again, it may sound like the solution makes good sense, because if it costs less, then you have less cash outflow, and that means, or at least on production, that means you can meet your other financial commitments, such as your debt finance and staff wages, etc. So, yeah, that makes sense, but it kind of draws on the typical possible crossover or confusion between profit and cash flow. And what Trevor's saying is the more important one, managing working capital, it's to do with cash flow. Profit is possibly going to distort. And I have another practical factor that I could put in against option B, and that's to do with just the time and the cost of re-engineering a product. Now, the current thinking on life cycle costing says that by the time a product has come to market, 90% or more of its costs are fixed, by which I mean they're determined. You're not going to be able to change them while that product is in its sales cycle. So if for the Osborne 1, where would they get fresh screens from? Where would they get fresh components from? Where would they get fresh materials from? Would they have a new product line? Remember that they were busy trying to develop a replacement computer for the Osborne 1. So would they go back and develop Osborne 1 a little bit more and in tandem try to develop a replacement product for it? I think overall that would have been far too costly and quite impractical, and the potential cost savings would be minimal.
Okay, so it's in terms of reducing the cost using any methods available, but you also recognize the fact that that might not achieve that much.
Yeah.
Okay, I think considering the situation here, where we're talking about working capital, essentially, what this brings to mind is in terms of matching. We have a short-term need for working capital financing, but we do need to bring in long-term financing, because if they had held on for a bit longer, they might have really been able to overcome the situation. So what we will have recommended for option C, alternative C, which I think is the best case, is to say, look for other forms of financing, either get convertible debt, which is much more reassuring to the market, or issue equity. Any of these methods will have enabled them to hold on longer. And probably instead of talking about Microsoft and talking about Apple, we'll probably be talking about Osborne Computers now.
Yeah.
Where we have one in front of us.
I think there are a couple of key components to what you're saying which are very true. I think the first being that at this point in stage they had a good name in the market. They were known as innovators. The market had seen success. They brought one of the first personal computers to life. So there was good standing in terms of their name. They may have been able to attract funding. They may have been able to attract equity funding as well. I think the question that we need to be posing is if their current bank wasn't looking to finance them from the perspective of their current product, how would they be able to engage them in terms of a new business plan with this new product that they had already, I guess, suggested to the market? And the fact that it had already been suggested may be a case in point to say, well, the market already knew of it. So the fact that it had been mentioned may be able to draw in additional financing like you've mentioned.
Okay. Peter, you want to sum up the case?
Working capital management is two-sided. There's the investment in working capital and there's the funding that we need to support that level of investment. And what you introduced as your proposal, I think has to be a given in this scenario. They've got a dead duck product. Nobody is going to be buying Osborne One, not at the prices they were that made the product successful. So invest no more money in that, no more cash in that, and let's just run down the inventories and see the back of that. And then introduce Osborne 2. But remember that Osborne 2 is happening 6 months, maybe a year down the line. You know, we've flagged it far too early. So we have a period during which we have expenses that we have to meet and financial commitments we have to make. So then we look at what Augustine has been talking about, look at the funding that we've got. And not just for the 6 months, just remember that this is a product that we're going to have for the next 2 years, maybe 3 years is going to be its life cycle. And think about funding that far forward and making sure that we don't commit ourselves to huge cash commitments in the coming 6 months when we know that all we have is cash outflows.
That seems to say it all, I think. I mean, with that sort of a solution, it fixes everything. Stop the production, don't keep it coming in anymore, and start reducing inventory and then raise cash to fix the situation with Osborne 1. And when Osborne 2 comes in, there's also working capital in place. Right. Thank you, gentlemen.
Pleasure.
Thank you.